Good morning, students. Good morning. It's a wonderful day again. Thank you. My name is Ogunribo Bamidele Emmanuel. This is the fourth module, which is the final part of the module for our intervention for my thesis program. I want to thank you for your contribution for the video and so this is to take into place contribution of our fourth module, which is accounting. We'll be looking at ratio analysis. And please, like what I've said, that for the flex blended model intervention that we're bringing in experiment, please note that I haven't watched the video as many times as you want. I'm still going to be available physically to attend to any gray areas that you have to. Now, thank you. I want you to also know that the video is available on YouTube and also on your WhatsApp group as discussed with your class government. Thank you very much, and let's dive into it. So this morning we'll be looking at ratio analysis. And the first thing we need to look at when we talk about ratio analysis is very simple. Remember, when we talk about ratio is something that organization have to do on a daily basis in order to look at that. And let's be very careful. Ratio is used as a benchmark for evaluating the financial position and performance of a business. Now, ratio helps to summarize large quantities of financials. Let's quickly look at something. We have these two persons in front of us, and their names are, we have Emmanuel, let's look at them, Emmanuel, Emma, and Ola. Now, we're told that this is their profit. Emma's profit is 8 million. Ola's profit, 20 million. Looking at this without questioning it, all of us will agree that Ola is doing better than Emmanuel. Okay, we are not disputing that. Further information given to us, Emma, is the sales of Emma that is 10 million, that of Ola is 100 million. The cost of sales of Emma is 2, that of Ola is 80, which goes back our profit that we all agree to be 8 and 20. Still looking at the volume in terms of profit, we'll still give it to Ola. But what ratio does now is just that it's not looking at absolute figure. Let's just dive into things we are comparing. Let's just look at one that we're going to look at a profit margin. That means we are saying profit all over sales times 100 over 1. Now let's see for Emma. Emma's profit is 8 all over sales of 10 times 100 over 1. That gives us 80%. While that of Ola is 20 all over 100 times 100 over 1. That gives us 20%. Now, this is now where we need to pay attention. Look at what we have here. The profit performance of Emma is 80 and that of Ola is 20. So looking at it, who is the best? The better of the two of them is what? Emma. So when we are looking at ratio does not just look at absolute figures. Look at the performance of the organization in respect to available items. And let's be very careful. That is what ratio does. You can see this relationship index and a yardstick which permit for quality judgment. So if you come here now, if you look at our judgment here, we have picked Ola, but here we can see that Emma is actually the one that is doing better. Now let's look at common ratios. There are large numbers of ratios that we have, but for this class, we'll be looking at 4 major common ratios: activity ratio, liquidity ratio, solvency ratio, profitability ratio, and valuation ratio. Now, for this class, before we came in, I have sent this to your class governor, in which I said we should read ahead. You can see all these formulas. Some of them you met them at a lower class, but we're going to elaborate on them. And these materials that have been sent to us. I said we should read ahead, and then we're going to explain some of them so as we move into the class. Now, number one, activity ratio. These ratios measures how efficiently a company performs on a day-to-day task. How efficiently a company performs on a what? Day-to-day task. Then the next ratio is ability to meet short-term obligation. What are your short-term obligations? So that is what liquidity ratio. That means how can you pay? Maybe you owe a debt between now and 6 months within 1 year. Why solvency ratio gives anybody that is looking at an entity financial record ability to measure their what? Long-term obligation. Profitability measures ability to generate profitable sales. So that is what we look at. While valuation ratio measures the quantity of an asset flow in and out. Now, all these ratios measure how organization performs. So the first ratio we're going to look at, which is somehow related to our working capital cycle, is what we call working capital. From what we have here, remember in our lower class, we would have been taught financial statement, statement of profit or loss, statement of financial position. So yeah, we are picking those components. And if you remember in the first module that we did, accounting process, that was why our accounting process class had to be large to bring ourselves to remember all those items. So you can see here, current asset, current liability. Now the difference between current asset and current liability is referred to as what we call working capital. Is referred to as what we call working capital. Is referred to as what we call working capital. Now we also have the next one, working capital cycle. Our working capital cycle talks about the inventory processing period. What is inventory processing period? And this you see when we move to higher class, but I will explain here. It's talking about the numbers of days it takes an organization to buy any item into the store, sell the item, and then be able to get their money back. So that is what we talk about inventory processing period. While the receivable collection period is talking about the numbers of days it will take an organization to be able to pay, to collect money back from those they have sold to on credit. So for example, if you have somebody that you have sold to on credit as a business, how many days will it take you to get your money back, to pay your money, to collect your money back from wherever you have sold to on credit? Is what we call receivable collection period. Why payable payment period is talking about the numbers of days it will take you to pay your suppliers, whoever you have bought from on credit, and this will give us a working capital cycle, cash conversion cycle. Now let's quickly look at this first one, very simple. And like what I said, ratios are not very difficult. There are key ones and you don't need to cram. Number one here, you are told. Let's look at this. Solution. Compute the working capital of Dr. Olafare Venture, given current asset of 50 million and current liability of 20 million. Okay, when we are given this, the question is what is working capital? So come here, working capital. For what we have done, we said there is the difference between current asset and current liability. So let's see the values written out in millions. So current asset got 50 million, current liability is 20 million. So what is the difference between current asset and current liability? That is 20 million. So without thinking much, you can see here that what we are having here is very simple. That our current asset is 50 and current liability. Simple. So now let's see what we have done with the first ratio we have there. So let's go to the next ratio. We'll look at what we call inventory turnover. What is inventory turnover? You can see the formula there. The formula for inventory turnover is cost of goods sold divided by inventory. Cost of goods sold divided by inventory. That is the formula for inventory turnover. And what does this mean? It's talking about the numbers of days it will take an organization to sell any good that is in the warehouse. Maybe they bought something. How many days will they sell? How many times, would they have to buy goods into the warehouse? That is turnover. How many times? Why inventory processing period is talking about the intervals in days. And that is that. Receivable turnover, from what I've said to you earlier, is receivable turnover is talking about the numbers of time that you are collecting money from whoever you have sold to on credit. Why receivable collection period is talking about the numbers of days it takes an entity to collect money back from whoever they have sold to on credit. If you see, when we talk about turnover, we're talking about time. We talk about period, we are talking about days. Now, let's look at this. Let's look at one thing that I quickly put here. Because if you look at this formula, a lot of you will meet it. You will see in another instance, they will call this average inventory. And that's why I quickly put in a question. The word average, we all know is like saying A plus B divided by 2. That is average. So in this case, the requirement here is talking about compute the average inventory. What is the formula for average inventory? Simple. I simply say opening plus closing divided by 2. So what's our opening inventory? That is 20,000 plus what's our closing inventory? 30,000, then divided by 2. That gives me 50,000 divided by 2, and the answer is 25,000. So what is average? Average inventory is opening inventory plus closing inventory divided by 2. Simple. Now let's go to the next one. Compute receivable turnover. Receivable turnover from our formula, we will not forget. It says sales all over receivables. So we quickly remind ourselves. This is sales all over receivables. So what's the value of sales? Sales is 200,000. What's the value of receivable? That is 20,000. Like what I've always been saying, the calculator is our friend. Can easily just cut it at 3 here, 1 here, naira, naira. So what do I have? 20, 2 here, 1, 2 here, 10. So our answer is 10 times. Is what? 10 times. Meaning that this organization collect receivables from the customers, from those that they have sold to on credit 10 times in a year. Now, this 10 times, in case we are not there and you are asked to calculate it in period, you can see there, we just do the reciprocal. So if you are to calculate it in period, which is receivable collection period. So that will just be the reciprocal, that will be receivable all over sales times 365. So what would that give us? That would be 200,000, sorry, 20,000 divided by 200,000 times 365. And if my calculation is correct, that will give us 36.5 days. Confirm, because poison is dangerous to earth. In accounting, we don't have, so let me write it out very well, 36.5 days. So that is it. Are we together? So that is it. Okay, let's revise it a bit. Like what I said, no rushing. You take the receivable collection period, see the formulas, and we have. So we also have this from what we've done earlier. I told you, payable turnover is talking about the numbers of days it takes an organization to pay back whoever they bought from on credit. Then times, rather, number of times for turnover, while payable payment period is number of days. Computation of purchases, we have seen this done in our first module when we talk about cost of goods sold. So cost of goods sold plus closing inventory minus opening inventory will give us what? Purchases. And that is how to compute. Now let's look at this. We now want to bring knowledge into it. We are told that state the best receivable policy in the 3 entities. Are we there now? Or among the 3 entities? Now, what we have here is receivable policy. Yeah, we are told that Dr. Balikis is going to what? Takes 40 days to collect from whoever he has sold to on credit. Dr. Giwa 70 days, while Dr. Onuga 25 days. Now, what are we testing here? The ability to look at it, business. Somebody has come to you as an analyst. You are told Balikis 40 days. They will collect money back from whoever is owing Balikis 40 days. Now, who do you think would have done best? When we are looking at this decision, we look for the shortest period. So in looking at this, the shortest period is going to be what? So that is the best. Because it's going to take the shortest period. Dr. Denga would have collected money 25 days. Look at Dr. Balikis. We'll still be taking 40 days and Dr. Giwa 70 days. So when we are faced with this, the best option in receivable is what? The shortest days. But no, it is payable. Payable payment period. The best is the longest day. Are we there now? So which day is longer? Because it's better to pay those you are owing longer and you have money. So we'll move to the other one, working capital turnover. You can see the formula there. And then we have talk about non-current asset turnover. That it says all over non-current asset. You can look at it. These are things that have to do with our modules. So you see, if you get to a higher class, will be more expand when you get to maybe professional exam. And then we also talk about current asset. This is current ratio, current asset all over current liability. No, that current ratio is also called working capital ratio. Working capital ratio. Don't mix it up together. Working capital is current asset minus current liability. Why working capital turnover? You can see there that is our working capital turnover. That is sales all over working capital. Why working capital ratio is also current ratio, current asset all over current liability. Now, we now have quick ratio too. We have current asset minus inventory divided by current liability. Cash ratio is cash plus bank plus marketable security divided by current liability. Now, if you look at this very well, this ratio module here is talking about how to compute. In a higher class, we'll be looking at more interpretation. But for this class, we look at how to compute. Gross profit margin, the one that we use the example of Iman, that's the gross profit all over sales times 100 over 1. Operating profit margin, that is operating profit all over sales times 100 all over 1. Net profit margin is net income, which is also called profit after tax divided by sales. Now, let's quickly look at these tax. I haven't done this formula. Let's chip in what we have. Current asset. I want you to quickly check your note. Here, we want to look at current ratio. We are told that the current asset is 60, and this 35 is our current liability. So, let's look at that. What is going to be our ratio? We have look check from what you have done from the video. If you can't get it, just wind back. But let me help you. We're coming here, we say current ratio is current asset over current liability. So what do I have? That will now be, remember, current ratio is equals to current asset all over current liability. What's another name for current ratio? Let's go back. It's also called working capital ratio. Working capital ratio. Working capital ratio. So in this case, the question is very simple. What's current asset? Current asset is 60,000. Current liability is 30,000. So what's my answer? Can use our auxiliary calculator is 6 all over 3. The answer is 2. So our current ratio is 2. Meaning that the ratio is 2. We have our current asset is twice our current liability, which you can pay without much adding. Now, we also have what we call the other ratios there where we talk about return on assets, return on equity, equity multiplier, interest coverage. All these ratios also underline what we need to get in terms of that. Then we have this for an advanced stage, which I want you to have as a knowledge. Now, in looking at these ratios, I want to just bring your mind back to integrate it to what we have here as activity ratio. They look at all what we have here. This number 4, 4, 5, 6, 4, 5, 6, 7, 8. Are we there? 9, 10, 11, 12, 13. They talked about activity ratio. So if you want to get activity ratio, our activity ratios range from number 3 to number 13. So number 3 to number 13. So that's our activity ratio, number 3 to number 13. There is a solvency ratio. You will see number 14, 15, 16, and 17. I don't want to give it 14, 15. So that is 13, 14 to 16. So when you are reading, you can also look at it by reading it. Then for solvency ratio, you are going to see, let's confirm, that is number, solvency ratio is number 22 and 23. 22 and 23. 22, that's number 22 and 3. Then when we talk about profitability ratio, where you get all our, that is from number 17 to number 21, 17 to 21. That is 17 to 21. 17 to 21. So that gives us all those ratios that we have seen. And like what I've said earlier, ratio is a very short topic for computation. By the time we get to higher classes, you will now see interpretation. We're able to look at the working capital, and then we'll also look at all these ratios. Let's see if you have any more examples, then we can go to the quiz. Compute gross profit given sales value. Remember this, we did that when we were starting. What is gross profit? Gross profit is the difference between sales and cost on sales. What is our sales? Sales is 200. Cost of sales is 150. So the difference between this is called gross profit. And our gross profit for this one is 50,000. That is gross profit. Now, don't mix it up with quiz 7. We talk about gross profit margin. Gross profit margin is described as what? Gross profit, all over sales times 100 over 1. Now, let's look at this question that we have. What's our gross profit? We don't know, but we know our sales is what? 200,000 times 100 over 1. So we need to get our gross profit. We need to check our gross profit. We know that the difference between sales and cost of sales will give us our gross profit, which one is 40,000. So that gives us what? 40,000 divided by 200,000 times the 100. What will be our answer? Like what I did tell you, calculator, your friend. So what do I have? This is 3 zeros, 3 zeros, 1 0, 1 0. Do your calculator, 0 cancel 0. 2 here, 1, 2 here, 2. So that gives us 20%. So like what I've told you for your test, get your calculator available. Now let's quickly go delve into this quiz. And you can see, like what I told you, is not too much when we are looking at ratio. Now, if opening inventory is 3,000, closing inventory, which is also constant, want to stick to it, inventory is 1,400. Compute the average inventory. And don't forget, it said average inventory is opening plus closing divided by 2. So what's our opening inventory? That is 3,000 plus 1,400 divided by 2. This is 4,400. So 4,400 divided by 2. What's going to be the answer? 2,200. So the best option there is D. D for distinction. Now let's look at this, a bit of mathematics. The capital of a business is 1/3 of its total asset. This will take us to what we did in module 1. I want to just confirm more. I'm bringing it to ratio. We said assets, what is it? Asset is equal to capital plus liability. And here we're told that our total liability is 600, which means, and they told us that our capital is 1/3. Do not give us one of these. So when we have 1/3 of this, we should all know that this one is also the same as saying 3/3, meaning that liability is 2/3. So if twice of an item is 600, if I want to make it 1, because you are simply like saying 3 is equal to 2 plus 1. So if 2 is 600, it means that I can divide this by 2 to give me one of these. So if my capital is divided by 2, that gives me 300. 300 plus 600 will give me 900,000. That's indeed the ratio that goes into mathematics. The answer is 6. So some of you would have applied 1/3. 1/3 on 600, and your answer is 200, 300. No, no, no. Are we there? The answer is 200. No, please. Now let's look at the proportion in which current asset of a firm is with current liability. Is very simple. They say proportion of current assets all over current liabilities is called what? We've done that in this class from working capital. It's called working capital. Now let's quickly look at the next one. Comma. And with the venture makes a profit of 25% on all sales given this. What is the cost of sales? Don't forget, we are told that the sales is this. So for us to get this, remember, we always say sales minus cost of goods sold give us profit. And in this case, we have sales already, which is 125,000 minus cost of sales, we don't know, but our profit we are told is 25%. So what's 25% of our sales? We quickly pick up our calculator. Like what I always tell you, that calculator is our friend. Counting is the most easiest subject in life. I always tell you, it's plus or minus 9.25. So our profit there is 125,000. And for us to get our cost of sales, very simple. We just say sales minus profit. So what would that be? That's 125,000 minus 125,500. Let's do a simple mathematics of that. Minus 312,500. So the answer is, if you have used the same calculator as done, is 937,500. B. Try confirm yours before I move ahead. Confirm yours so that you will not think I brought the figure from home. Please confirm your own value. Is it confirmed? Yes, thank you. Now, what is the formula for calculating quick ratio? That one, I want you to digest it. Remember, I gave you, let's just look at it. They told you current asset less inventory divided by current liability. Okay. I think for short, and that's good. That's the right answer. But yeah, current liability, no. Current asset less cash, no. Current asset less inventory divided by current, no. So the right answer here is A. So I want you to also confirm that from your material. Remember, we did that today. So look at that. Okay. You also look at the next one. We are told that the current ratio of a day is 2, while the current liability is 10. So what comes to our mind? In this case, what are we looking for? Look for the current asset. What comes to our mind is 10 million. Simple mathematics. So we are saying current asset all over current liability is equal to 2. And we're told already that we don't know our current asset, but current liability is 10 million is equal to 2. So we can cross multiply, meaning that our current asset is going to be 10 million times 2. And the answer is what? 20 million. So we have 20 million. Now let's look at this. The receivable collection period of Zenith Bank customer, namely Busola, Bola, and Yinka, as follows: 10 days, 40 days, 120 days. So state, which of the customer managed the debt collection effectively? Remember, we said this in the class, and I can still remember that question that we did. And we're talking about receivable collection period. We said the shorter. So which one is the shorter or the shortest? Here, in this case, that we have 3 situations. So looking at this, the best is what? The solar. So that is the best receivable. Now, given VAT limited sales value of 200,000 and cost of sales of 150,000, compute the gross profit. Simple. Remember, here we are asked for gross profit margin. So that is gross profit over sales and 100 over 1. What do I have? Gross profit is the difference between these two, which is 50,000 divided by 200,000 divided by 100. Simple, simple. 0 cancel 0. 8 0 cancel 0. So 2 year 1, 2 year 5. So we just have 25%. What I told you, so you can see me, I still love my mathematics. I told you, calculator will do it straightforward. Now the cash ratio of I Limited was greater than 1. The result indicates the firm's liquidity is what? Once you have anything in terms of current ratio, cash ratio greater than 1, it means the organization is having adequate liquidity. That is cash is more than his liability. His cash is more than his liability. Now let's quickly look at this final one. I don't know. Yes, before I say thank you. The receivable turnover of Alaja Venture showed 10 times. State the receivable collection period. I've told us that there's a formula for this. The general formula for this is that you'll be seeing what we call sales all over receivable. But we said simply, once they're giving us turnover, we just say receivable turnover divided by 365, and which is very simple. So, what do I have? No, other way around. Let's do it the other way around because that is not that. That will be giving us the wrong figure. That formula, let's get it done. We said it should be 365 because we are converting to divided by receivable turnover. So that gives us 365 divided by what? 10. And that will give us 37 days approximately. So our answer is 37 days. Now, if you look at this, you will see that we've looked at all the quiz. And please, like what I've told you, this is to help us to be able to compute our ratio and this formula I've given to you. So what I'm going to say is I can see that I haven't done the ratio that concluded our 4 modules. So I want to say a big thank you, and I really appreciate you. So please, I want you to watch the video as many times as possible so that you can understand it, and then we'll get prepared for our post test. And I'm very happy. Thank you, and God bless you. Thank you very much. I appreciate you all, and I'll continue to say thank you for coming to my class and every other thing. Like what I've said, my name is Ogunribokun Bamidele Emmanuel. I am your tutor, and thank you. We'll get to say thank you very much. Please watch and revert. Thank you very much. See you physically for any further explanation. Thank you.